You have probably heard the term conventional loan on the news or read it about it online, but what is a conventional loan? A conventional loan is also called a conforming loan, and this is a loan that meets the requirements of Fannie Mae and Freddie Mac and conforms to their guidelines. Fannie Mae and Freddie Mac are government-sponsored entities that purchase mortgages from lenders and brokers, and then they sell them off to investors, life insurance companies, pension funds, mutual funds, and other investors. Hello, my name is Kevin Brierton with Neo Home Loans and the Brierton team. In this video, I'm going to share with you what you need to know about qualifying for a conventional home loan. Now, there are several different sets of guidelines that the loan can fall under the umbrella of a conventional loan. In general, conventional loans have stricter credit requirements than government-backed loans such as FHA, VA, or USDA. And it's possible for a first-time home buyer to get a conventional loan to buy a house with as little as 3% down. Now, however, down payment requirements can vary based on the personal situation and also the property you're looking to buy. But if you're not a first-time home buyer or you're making more than 80% of the area median income, then you might need to put down at least 5% rather than 3%. If the house you're looking to buy is not a single family house, so for example, if it's a 2, 3, or 4 unit, you may need to put down a larger down payment, closer to 15% down, and that'll vary based on the property type and of course your credit score on qualifying. If you're refinancing your conventional loan, you'll need to have at least 3% equity, and in all cases you're going to need, some cases you're going to need 5%. And it depends on what you're doing, if you're doing a cash out or no cash out, because if you do a cash out loan, you're going to have at least 20% equity left over in the house after you do the refinance. So whatever you take out can go no higher than 80% of the home value based on an appraisal typically. Now, if you put down less than 20% on a conventional loan, you're required to pay private mortgage insurance or MIP or MI. Now, PMI protects mortgage investors in the case you default on the loan. The cost of the private mortgage insurance varies based on your loan type, credit score, and the size of the down payment. Now, your private mortgage insurance is usually paid as part of your monthly mortgage payment, but there's other ways to cover the cost. Some buyers will pay the fee up front, included in their closing costs. Others can pay the form in a slightly higher interest rate. Sometimes you can get the seller to help with credits to actually pay this for you, which is a great option in this market right now if you can negotiate the right deal. Choosing how to pay for the private mortgage insurance is a matter of running the numbers and figuring out which is the cheapest option. One of the things that I'll point out is some places will say they don't have mortgage insurance on their loan. They're typically lying to you, because what they're saying is we just don't charge you, or we don't show you what it is. And there's usually a cost behind the scenes going on, but they have either increased your fees or increased the interest rate to cover it. I like to be transparent and show you the options. I believe that's the best way to do it. So even though they may have a no mortgage insurance option, ask them to talk about all their options they put on the table and make sure you have the right one that fits your needs. The nice thing about private mortgage insurance is that it won't be part of your loan forever for conventional. This means that you won't have to refinance to get rid of it. When you reach 20% equity in the home and your regular monthly payment schedule, you can ask your lender to remove the private mortgage insurance from your monthly payments. If you reach 20% equity as a result of the home value increasing, you can contact your lender for an appraisal. Sometimes they'll do a drive-by appraisal, sometimes they'll do a full appraisal, and sometimes they'll do an online appraisal. So then they can use the new value to recalculate the math they're going to look at for calculating your private mortgage insurance. And once you reach around 20 to 22% in equity, your lender will actually automatically remove it if you hit the 22% based on your original amount. Then 22% equity, then your lender should be removing it. What I find is it's best to proactively look at your valuation on your house and then also look at your loan amount to see if you have 20% equity, and then proactively ask for it to be removed. Surprisingly, lenders aren't going to just drop it off earlier than they have to, just because it protects them at a higher rate. So just be aware, be proactive with this. I actually just dropped mortgage insurance off of one of my properties, and it was a fairly painless process. I had to wait about 30 days for the whole process to come together, but it worked out and I was able to drop it significantly sooner than if I waited for the bank to reach the 22% based on their math and when I bought the house and based on my purchase price. A few other requirements for a conventional loan: credit score. In most cases, you're going to need a credit score of at least 620 for most conventional loans. The debt to income ratio you're going to need, this is what's called DTI, you'll hear, is a percentage that represents how much of the monthly income goes to debts and including your monthly payment. So the new house payment plus all of your debts that are showing on your credit report. Other things can be included, like if you have IRS payments, if you have child support, alimony, other items can be included in that number as well. So make sure you disclose that information, because the lenders or underwriters will typically find it out. You don't want a surprise down the road. But for conventional loans, most of them, they're going to want their debt to income ratio at 50% or less. So if you're doing the math on this, take all your income. If you make $5,000 a month and you have 50% of that is $2,500, and let's say you have $500 between auto loans and credit cards, subtract $2,500 by 500, and then $2,000 will be your theoretical max housing payment based on a 50% debt to income ratio. Now, loan size for conventional loans, your loan must fall within the loan limits. So Fannie Mae and Freddie Mac set the loan limits annually, and this does change annually. There are exceptions, however. Some states like Alaska, Hawaii, and other higher cost states will have higher limits. So to see your area, visit Federal Housing Finance Agency website, and that's a great place. You can also type in conventional loan limits 2023 into browser. That's a great way to find the information as well. And you can always message us and we can take a look at it if you have a city or county we want to take a look at for you. What are rates for conventional loans? Well, interest rates for conventional loans change daily. So conventional loan rates will usually be variance based on the market, your loan level pricing adjusters. There's about 30 different things that actually go into making up the interest rate. So whether it's credit score, loan amount, what type of property you're buying, single family, multifamily can play into it, whether it's an investment home, primary, condo. So just know there's 30 different factors. There's no one rate out there. There's average interest rates, but there's no one rate out there for everybody in every situation. And they can vary from FHA and VA. So sometimes it's better to compare a conventional loan rate to an FHA or VA if you qualify, because conventional loans are going to be more heavily weighted based on credit score, where FHA and VA, let's say you have a low credit score and you're trying to get a loan and you have a 660 credit score and you try to get the same loan under FHA and conventional, typically you'll have a better rate on FHA or VA compared to conventional if you have a lower credit score. So always look at the comparisons on it. Don't just think one size fits all and think gotta go with conventional, it's the only way to go. Take a look at all the options and set them side by side to see what's best. Bottom line is conventional loans generally offer lower costs than other loans. And if you meet the criteria and you want to do a down payment as low as 3 or 5% down, depending on your situation, it might be the best solution. But to find out what you qualify for, you really want to talk to a licensed mortgage professional that can help you decide on the options and lay them all out side by side with a comparison. Thank you so much for watching. My name's Kevin Brierton with the Brierton team at Neo Home Loans. If there's anything I can do to help out or answer, don't hesitate to reach out. You can call or text 480-553-8770, or feel free to shoot me a message or DM here, and we're excited to help. Thanks for watching.